Now we're going to answer the question. The abridged profit and loss account we have already done. Now let's have a look at the reconciliation of operating profit to net cash flow from operating activities. If the operating profit of 143,000, which we calculated earlier on, depreciation charge for the year, profit on the sale of fixed assets. Now, if you had a loss on the sale of fixed assets, you would put it in there as well. Increase in provision for bad debts. If there was a decrease in provision for bad debts, you'd put that in there. Increase in stock, increase in debtors, and a decrease in creditors. Now notice that the increase in stock and the increase in debtors, you're increasing an asset, and yet there's a minus figure. Remember, we're looking at money in and money out. If you're increasing an asset, there's money leaving the factory. That gives us net cash flow from operating activities. The next thing then is the cash flow statement of Quick PLC for the year ended the 31st of 2014. Now this is the standard layout. You must know the 7 headings: operating activities, return on investment, taxation, capital expenditure and financial investment, equity dividends paid, right, management of liquid resources, financing, and decrease or increase in cash depending on what it is. So your operating activities, net cash inflow from operating activities, so 138,000. You got that from the first reconciliation. Now, return on investment and servicing of finance, you have interest paid 18,000. Taxation paid 57,000. Capital expenditure, the sale of fixed assets, the purchase of fixed assets, and the sale of investments. Equity dividends paid or dividends paid. Management of liquid resources, government securities, and financing, the issue of debentures, issue of ordinary shares, and issue of share premium, giving you a decrease in cash of minus 13,000. Now we're nearly finished. You've got the last thing you have to do is do a reconciliation of changes in cash to changes in net debt. So reconciliation of net cash to movement in net debt. Now the first thing we have to do here is calculate what the net debt is. So the net debt, I've worked it out here for you. For 2014 and 2013, we have cash minus bank overdraft, which we owe, minus debenture, which we owe, plus government security, which we own. So our net debt at the end of 2013 was 101,000, and our net debt at the end of 2014 was 108,000. So the movement in net debt was minus 7,000 for the year. Where did that occur? And we go reconciliation of net cash to movement in net debt. Decrease in cash, which is minus 13,000. The purchase of liquid resources, 56,000, and cash received from the issue of debentures, 50,000, giving us a change in net debt of minus 7,000. And the opening net debt is 101, and then so therefore the closing net debt is 108,000. Now it's only 5 marks going for that, but still it's important to know. Let's have a look then. Why are cash flow statements prepared? To show that profits do not always equal cash, to show that cash inflows and outflows during the past year, to help predict future cash flows, to help financial planning, to provide information to assess liquidity, to comply with legal requirements, which is of course has to be, these are now part of your financial statements, and to aid application for loans. Explain a decline in the company's cash balance in 2014. The purchases of fixed assets reduced the cash by 220,000, but did not reduce profit. The purchase of government security reduced cash by 56,000, but did not reduce profit. Payments of dividends and tax reduced cash by 112,000, but did not reduce profit. Increase in stock, debtors, decrease in credit reduced cash, but didn't reduce profit.